Welcome, everyone. Thank you for hopping on. A lot of you were early. I love seeing that. We're going to keep this right at an hour tonight. And you know us here at Factum Financial. We are big on education. The right education brings the right awareness, Paul. And the more aware we are around some of these strategies, especially the infinite banking concept, I think the better utilization we have when using these life insurance policies as part of our investment philosophy, which is what our conversation is on tonight.
Yeah, I'm really excited for this. This is, I know Dave and Wade are going to be joining in on this conversation, but this is stuff we talk about when we're sitting around at lunch or dinner, and we're talking about how we use our policies or something good or bad that's happened in our life and how the policy may have helped. So it's a great conversation. Excited to get it rolling.
All right, let's do this. So if we go back over a decade ago, everyone called me crazy when I was buying my first life insurance policy. Grandfather, family, friends, mentors, don't you dare buy one of those whole life insurance policies.
What are you doing? You're getting scammed.
Those things are expensive to own, worst investment of all time. Everyone was telling me you're crazy. Now, we're going to be showing you an example of a property that my wife and I bought after talking to some wonderful real estate professionals here in the local Phoenix area. I was waiting to buy real estate because with my limited knowledge of real estate, Paul, I was waiting for a correction to happen.
Yep.
Luckily, we're tied in with some wonderful Keller Williams professionals. And one of the guys I was talking to just said, I don't want to burst your bubble, but the market's not going down anytime soon. This was like 6-7 years ago now. It was only about to skyrocket in the Phoenix area. So I'm so glad we bought this house. Now, had I been using my own cash to buy my first home, which is what everyone was telling me to do, right, use cash for the down payment. If I would have done that, that one decision would have cost me $180,000 in just interest costs. And this was not like a substantial down payment on this primary residence we bought, okay?
And just that cash leaving you, right? You're writing that check. You're never going to see it again. It's going to go to the bank to cover the down payment for the mortgage.
Gone forever. Leaves my family's wealth permanently.
180 grand.
180 grand. Now, we ended up selling that property a couple years later, and we took the proceeds, the net profit of that. It was a good investment we made. Yeah. And that has added over $1 million to my wealth plan. The best part is it's guaranteed. I can use that money now for retirement. It's guaranteed retirement for me. It's guaranteed passive income, and it's also guaranteed legacy for my kids, however I want to use that. I can use that as retirement. I could use it as legacy.
And this example is currently the same, right? So this is whether you bought the house with cash and typical financing or whether you bought the cash using down payment from your whole life policy.
There you go. That's
and you
it.
Sold the house at the same value.
That's right. So we're going to take a look at this. So the impact on my wealth plan using a life insurance policy, we're going to get to in a minute, to go purchase a property. So option one. Now, if you're on the call today, I'm just going to tell you 100% of us on the call are still using option one. Yep. We all use some type of bank account. If you're deep into infinite banking, if you're buying whole life insurance, there is no way to get around the function of using a commercial bank as our primary liquidity reserve. We just need that fast transaction, that pace. We need that convenience. And all of us utilize option one, okay? So in option one, if we go back to 2020, we're going to go back in time, Paul. We buy this $335,000 single family home after a real estate professional told me you should buy real estate now and just wait. Yep. Don't wait to buy real estate. And so the down payment needed for this property was $17,000. Now, what most of us are going to do prior to knowing what we teach here at Factum is we're going to be having that checking or that down payment sitting in some type of checking account at Chase Bank earning us 0.01%.
Got to show the bank that it sits in your cash account. It's available to you. You're not borrowing it from someone.
That's right. And so if we take that money out of that checking account and now we use it to make the real estate transaction a reality, that $17,000 leaves my family's wealth plan permanently, forever. The 17 grand is forever gone. And so the interest cost, assuming I could have put that in another location and earned, let's call it 3 to 4% on that money, to age 90 for me, that $17,000 decision doesn't cost me 17 grand. It cost me almost $180,000. And we're going to be
down payment.
That's a big down payment. So
almost equal to the house that half the house.
Back then, that was half the price of the house exactly. Now, what we did instead, we added one extra step. Because I had already learned about whole life insurance, I was familiar with the infinite banking concept. what my wife and I did is that we took this $17,000 that was sitting in a checking account, we ran it through an insurance policy that's going to earn me about 4% net, and that's a long-term rate of return, which means now the interest earned just for flowing that money into a more efficient environment is now going to grow to about 180 by age 90.
And tonight we're going to show some proof of this, but at that moment, that wasn't earning you 4%, right? So that's not what we're saying. But you never do anything for the next day, right? Sometimes you do things to plan forward, and that 17 grand in the policy, long-term, 20, 30, 40 years to the age 90 will be worth a whole heck of a lot more.
Absolutely. So I did take a policy loan. So I put the $17,000 into an insurance policy, and then I borrowed against it. And the time that I had the loan outstanding, we made no principal payments back. The interest that I paid on that loan was $2,000.
Yep.
So I want to make sure that we're comparing this. And by the way, these monthly deep dive classes we teach, we're going to go deep on the implementation and strategy. Like if you want to see how to actually utilize infinite banking and whole life insurance, this is a time to ask those questions and to see like the proper flow of money and documentation, everything. So we want to make sure that we're comparing everything apples to apples. Now, 2023, 2.5 years after we bought that home, the Phoenix market was crazy. We call this an event. There was an event happening in the Phoenix area. We had so many people moving into our state that it was driving up the prices so aggressively. And we were seeing $100,000 over asking prices, waiving inspections, waiving appraisals. It was this crazy time. And I told Diane, I said, we need to sell this thing and get the money out of there and get it into our world.
And you guys were living in the house?
And we were living in the house. We're going to see that house in just a minute. Diane loved that house.
Yeah, I was going to say,
a lot.
Kind of a little bit of a,
it was
I'm bringing a move.
It was a conversation for sure. We'll put it that way.
Yeah.
Now, we made about $200,000 net on the sale of that home.
Helps ease the conversation.
That she was okay with, right? Now, assuming best case scenario, because what do most people do, Paul, when they make an investment and they have net proceeds?
Honest to God, most people spend it, right? Because it leaks from us, right? And that's every single one of us here. I'm no different. If it's sitting in an account that allows me to spend, I'm going to spend it. But if you're really good, if you're like my grandfather was, I remember him always talking about the bank. So you put it in a bank. Well, that's maybe get 2.5%, 2.6%. I mean, I know anyone who's younger than 30 or 40 probably thinks that's a ridiculous number, but way back when, we do remember savings rates even higher than that. But 2.6%, Dave will kick in and say that's been the average over the last 60 years.
At least in U.S. Treasuries, right? So the human behavior is going to kick in when you see $200,000 suddenly hit your account. And you're going to go, maybe we should get a boat.
Yeah.
Maybe we get a new truck.
Yeah.
Maybe it gets easy to want to spend money when that happens. This is why you got to get on our tough money curriculum so that those financial management habits are dialed in.
Yep.
So that $200,000, best case scenario is we go put that in a very liquid, safe asset that's going to have a decent yield with no risk over a long period of time, which if we took that one investment we made and just plunked it into U.S. Treasuries for 60-something years, it would earn us about $935,000. That's not bad. A $17,000 investment we made $200,000 over 2.5 years, and then we just put it in a safe, secure location. Forget about it. Not the worst situation in the world, right?
No, not horrible.
Not horrible.
You're sort of keeping up with inflation at
Right.
that rate.
So let's look at what we actually did. Now that's best case scenario, and I don't know almost anyone who would do that. No one's disciplined enough that we work with in the United States that says we're going to make this much money and we're going to keep 100% of that net profit in the most liquid, safe, secure environment.
And my hunch is someone out there is going, well, I wouldn't put it. What if I put it in the stock market, which is a little bit different, right? Because then you're taking on risk. So we're talking about riskless assets right now.
We're not even talking turning the money,
Yeah.
right? So some of you on the call are wonderful investors. You say, well, I would take that $200,000, I would just flip it. And I'd keep investing it and turn it into a ton of money, right? So we're just saying if we were just to be as conservative as possible, $935. Now, what did we actually do? We took that $200,000, we put it into some insurance policies we already owned, which are going to earn us about 4% net long term, and that interest would be about $2.1 million. Now, everyone is doing option one on the left, using a checking account for these major transactions. All we're saying is if you add one step to that, you're going to keep about $2.1 million on your side. Or best case scenario, there's a $1.3 million increase to my wealth plan by just sticking it into my life insurance contract.
Yeah.
No risk, no noise, guaranteed. The best part is we can still use that money over my
All the
lifetime.
time.
Go do this again.
Accessibility without breaking the compounding chain, which is giant.
Absolutely. So let's take a look at this. Let's go back in time a little bit. 25-year-old Kyle.
You still kind of look like 25-year-old Kyle.
Thank you, Paul. I can't grow like any facial hair, so it's like I might as well just keep. Maybe if I could grow like a goatee or something, I might look 30. So let's go back in time. 25-year-old Kyle. I'm learning from this orthodontist who's teaching all these other millionaire dentists and surgeons about becoming your own banker. They were all business owners. They were all investors. He was teaching them how to control the flow of money in their life. And so 25-year-old Kyle shows up, and I'm learning about this. And back then, I'm like, well, man, if I just put money into whole life insurance, I'm going to get a much higher competitive yield. This is 25-year-old brain Kyle thinking now, right?
Yep.
I wasn't really thinking about death benefit protection for my family. I wasn't thinking about privacy. I was thinking about I need a more efficient place to store my savings. So if I started buying whole life back in 2015, the interest rates back then were literally zero. You could not find any liquid safe environment that was offering any type of growth or yield, okay? So that right there, that red arrow, that's when I started buying whole life insurance. Now, here's what's interesting. This red line across the top now, look at the parts in blue. This was the only time that other liquid safe environments would have been relatively similar to the growth you get on your whole life insurance contract.
Not very long.
Everything below that in white, and we could take this back 40, 50, 60 years, it's going to be really tough to beat life insurance as a liquid safe environment. So 25-year-old Kyle's looking at this and saying, that's a pretty good place to store my cash. Even today, in today's environment, and by the way, the growth on our policies, it's net.
Yeah.
We're looking at a gross return on this graph, but the policy growth is net.
Yeah, so any of my physician friends out there, a 4% net is equal to you probably about 6.2% at your tax rate, right? So that's a giant bonus, the fact that that's net of taxes.
Well
And
said.
if you have friends in California,
Yeah.
Paul, then it's probably what, 10? I'm just kidding, but
The higher the taxes, the stronger that policy actually performs for you. So we got a couple options here, and most Americans are just utilizing option one, hold money at a bank. There's no real rhyme or reason as to what's happening with interest rates. So if you have savings and someone's willing to pay you some yield, you can capture it for whatever time period they offer it. With whole life, you get that locked in permanently.
Yeah.
That was something I was definitely looking for as a 25-year-old. So I utilized option two over a decade ago. I'm going to hold more of my money in whole life insurance. And yield was definitely a major contributor to that. So let's look at the oldest policy I ended up buying after hearing that orthodontist speak about this. And back then, people were saying, you're crazy, Kyle, because those policies have a low rate of return.
Yep.
Now, Paul, why do they say it's got a low rate of return? What are people typically comparing this to?
Comparing it to the stock market, which if you look at inflation adjusted returns will get you around 6.5 to 7% adjusted for inflation, long-term average, not actual, but average. That's what they're comparing it to, right? So when you say 4% versus 7%, well, heck, I'd rather get 7%.
Absolutely. Biggest conception about life insurance is people look at it as some type of investment.
Yeah.
And that's why we're so confused on the benefits and especially the yield.
Risk, when you do an investment, there's risk. This is literally almost a risk-free environment.
Absolutely. So people were saying, you're crazy, Kyle. Life insurance has a low rate of return. Go buy real estate. Go do other things. They were talking at like investments, though. So let's take a look at this policy. This first policy I bought has a long-term internal rate of return of about 3 to 4% net. That's going to be what the carrier is going to offer you long-term, okay? Now, this policy that I still have today grows about $500 every single month. That's net of any taxes.
And Kyle, that net is on cash value growth, right? Not if you combine death benefit, it's going to go up quite a bit. But that's just straight cash value that's accessible to you for the life of the policy.
Absolutely. And this number goes up every single year. So
every month, right? Yeah.
Low rate of return, even in today's environment, I have not met one person in the last 10 years that could beat efficiency from a savings environment that this policy has gotten me the last 10 years.
Yeah, you look at when high yield savings accounts became sort of beneficial again, that every single, you go to Bogleheads, you go to all the Reddit groups, they're all saying, oh, dump your money into high yield savings account because you're getting 3, 4, sometimes upwards of 5%. You're getting this all along. still having access, can take, I mean, all the other benefits, but
And it's locked in.
yeah.
If interest
It's not
rates
going
come
down. Yeah.
if interest rates come down, my policies still do their thing every single year, right? Now, another big thing people were telling me back then is don't buy whole life. Just you're young, buy term. It's cheap, and exactly invest the rest. Now, this policy, I've paid in about $98,000 of premium since I bought this thing. I have over $103,000 of available cash value and a death benefit of $730,000.
So you paid $98,000, but you could tomorrow get a check for $103,000.
Over 100% of my premiums paid.
Seem that expensive to all.
So this is a really interesting point, because when you get policies that are this old, you're going to see this crossover where suddenly now, if I have recouped over 100% of my premiums, Paul, and I still have the death benefit, that is the cheapest insurance I will ever own in my entire life.
Yeah.
I've been paying home and auto insurance for, almost 20 years now. Do you know how much equity I have in the home and auto insurance I've been paying?
I just sent checks for disability last week, and that's a big check every 6 months. So most insurance, we write the check, we hope we never have to use it, and it's gone. But this insurance, you're guaranteed to use it. Your family will use it at some point in time. But the cost is patience.
Absolutely. And what's interesting about this is, when I was first buying this, I saw the living benefits like, man, that's a great place to store cash. I love the benefits of it. I wasn't really thinking about death benefit because it was just Diane and I back then.
Yeah.
Now, several years later, we got 4 young kiddos. I'll tell you that death benefit is more important to me now than it ever was the last 11 years.
Yeah, I'll get into that later, but
we're going to get to that.
It's people undersell the death benefits a lot of times in these things, in these policies, but their death benefit buys you so much joy in your life. It's a really nice thing to have.
Peace of mind, options. And the last thing they were telling me, Paul, is these are the worst investments you could ever buy because they're expensive and because they got a low rate of return. If you've been on any of our education, we have to constantly be repeating this. Whole life insurance is not an investment. It is the biggest misconception people have. And if we can't get past that it's not an investment, we're so confused about where this asset belongs on our balance sheet.
Yeah. So young Kyle, you bought a policy, you used the policy for a down payment on a house that ended up becoming an investment, even though it was your house that you're living in. So the policy wasn't the investment, but the policy gave you some leverage to do an investment.
Absolutely. And back when I bought this policy, the minimum premium for this first policy I bought, Paul, is $220 a month. This was not like a big boy policy, right? We're going to show your policy that was a tad bit bigger than this one, right?
This is like a water bill in Phoenix, $200, right?
And so everyone on the call tonight can be starting a policy like this. The minimum required premium to keep this thing in force and do its thing was $220 per month.
Yep.
That's what my wife and I contributed to this. So this is a policy that everyone in the United States honestly can be funding, and you should. The sooner you start this, the sooner that starts to compound, and the faster you get to some of these years that we're looking at right now.
And the great thing is this is the first. This was 2005. This is the first 11 years, and if you fast forward this policy to year 20, year 30, or 40, it gets really inexpensive. Let's put it that way.
So let's take a look at that. So if we go into year 13 on this policy, the scheduled premium is $8,000 a year. That's what I committed to. That's how much I'm going to save into this first policy is $8,000. The minimum was $2,600 or $220 a month is the minimum. Okay. So in this 13th year, I'm going to pay in $8,000 of premium, and it's going to grow by $13,000 that year, or $1.63 for every dollar I put into that thing. Paul, that is the easiest place I have ever saved money in my entire life, is to put in $1 and no risk, guaranteed basis, it's going to spit out $1.63 for me that year.
That's a pretty good machine to feed.
That's a pretty dang good machine to feed. Wait till you see Paul's policy in a second. If we go,
I think about the policy number, the $220, right? I can't remember. I was reading a study where it talks about the amount of subscriptions we now have that we don't know we have, right? And that's where, there's all those apps that will come up and say, identify them for you. My hunch is everyone on this, I'd be curious if anyone has actually looked at this lately. How many unused subscriptions were you doing, and what was that value per month? Because I don't think getting to even $250 a month is too difficult to do for probably everyone on this call.
Right. And if we go another 15 years, and the reason I'm using 15 years, I think most people could win the money game in a 5, 10, or 15-year time frame if you have the right wealth team and the right strategies and the right assets in place.
Yeah.
Now, if we go another 15 years, which statistically I'm going to live another 15 years, I'm going to pay in the same $8,000 in that year. It's going to grow by $24,000 that very year, next year, or $3.10 for every dollar I put into that thing. If we go another 15 years, Paul, and we reduce this down to the minimums at $2,600 or $220 a month, if I pay the minimum on this thing year 43, it's going to grow $36,000 with $2,600 of cash saved into that, or $13.50 for every dollar I put into that thing.
So I'm just doing some rough calculations, but about year 30 of the policy, age 56, you'll have roughly $240,000 put into it, and total net cash value of $465,000. So anyone who says these policies are expensive, would you like to have something that's guaranteed? You put in $250,000, does all these other things, protection, right? There's over $1 million of death benefit during that time. There's all the other options to use loans, and there's disability and long-term care riders, but you have $450,000 in return for your $250,000.
No risk.
No risk.
Completely
And
liquid.
by year 43, holy goodness, $13.
You know, and it's that orthodontist that was teaching me this. He was 65 when he started this. And he literally told me, because I would take him to lunch as often as he had let me, and I would ask him questions about this stuff. Then he said, you know, Kyle, I'd give up all my wealth to go back in time to be your age and start some of these things now, which is why we have so many adult clients that when they see this, they're like, I need to put a couple $100 a month on my kids.
Yeah, I'm angry at Wade, who sold me my first policy, for not talking to me 10 years earlier.
You know, that's going to start coming up. Every person that has an agent that helped them get one of these started is going to be upset with us that their first policy could only hold about $8,000 a year. Yeah. It's going to happen to all of us. I wish I could put $80,000 a year into this policy. You add a zero onto this and the numbers just change. Just add one more zero on the side. So let's talk about this now. 25-year-old Kyle starts buying that life insurance policy because I need a more efficient place to hold cash. And then we buy this home, this $335,000 single family home. We only had 2 kids back then. Diane loved this home. I love this home. This is like the greatest home ever. Lots of good memories.
Is that way?
Yeah, you know, great memories for our family. We still talk about this home. I told Diane, but think about all the memories we're going to have with $200,000, right? Like that was the only way to get her out of the home, was like all the experiences we're going to create with this. So I got about $60,000 in a life insurance policy. Okay, so literally I take savings from the bank account and I just move it to an insurance contract, and once it's there, it is permanently mine forever. Yep. Those dollars will never leave my family's control, Paul, ever. Indefinitely, they are ours.
The day you write the check, that guarantee happens.
That guaranteed happens. So this home only required $17,000 down. So rather than using our own cash, we took a loan against the cash value. So when you do this, the insurance company is going to look up Kyle's policy. They go, he got $60,000 in there. Of course, we'll lend him 17. So they kind of put a little lien against your policy, but I'm still earning interest on that full 60.
Yeah.
The insurance company is going to send me a check for $17,000, which I'm going to pay about 5% interest on that 17 grand, because it's the insurance company's money I'm using. You don't borrow from your policy. You borrow against it, okay? Your cash value is the collateral. You're actually using insurance company's money. That's what we used to go make this house purchase. And then we sold that home 2.5 years later and made a couple $100,000. And what we would do with that money is we would go reduce the loan, pay it off to the insurance company, free that up again, and the additional cash flow is going to flow right into that insurance policy. Look at how simple this is. Most of you on the call have been doing this your entire life. You've just been missing one step, which is add the insurance policy in there, which allows you permanent control of those dollars that are going to flow into it.
Yeah, and the great thing is, you know, these policies with a loan, you actually sort of build up a reservoir. So when you have a liquidity event, a capital event, a sale of something, you make a profit on something, that you have a place to actually put that money where it's immediately kind of going back to work for you, immediately accessible again. It's just it's a fantastic store of wealth.
That's it. So let's break this down again.
How hard are the policies to get, right? How hard are the loans to get?
So we're buying this home. Now, we submit a policy loan request. By the way, our office fills out like 70% of this for you. There's only about 6 fields to fill out, and we will fill out about 4 of those for you.
Right.
We can't do the signatures for
And
you.
that's getting your spouse signature. That's the hardest one, right? Honey, will you sign this?
You got to put pen to the paper and sign. Now, when we took this policy loan, it's a 2-page form, Paul. There's no credit check.
No.
They don't want to see tax returns.
No.
They do not ask for an amortization schedule. How and when are you paying this back? It is the most flexible loan you will ever access in your entire life. Ultimate freedom with this. Now, you can't abuse that, which is why you got to get on our tough money curriculum. Having tough money management habits will save you from abusing how flexible this loan provision is.
Yep.
Do not abuse the freedom and flexibility here. But this is literally the form. $17,000. We want that in an electronic funds transfer, and sign it. We're done. Within about a week, we had the funds in our account. We told the lender we are getting some cash from our life insurance policies. They asked no further questions.
Yep.
We funded the property and had a wonderful 2.5 years there. Simple as that. So the impact on my wealth plan, just by adding that one extra step for the Fuller family. This was one investment we made. It wasn't even meant to be an investment, but it turned out to be a really great deal. That's kind of how life works sometimes. Yeah. That one investment with the right savings environment will put over $1 million increase on our wealth plan. No risk, nothing else. That is all guaranteed to happen now. Now, as that policy explodes by running more savings through it, you can use that again.
I'm going to even say that, again, that 1.3 is if someone actually had the discipline to take the $200,000 profit that you had and either perhaps invest it or at least put it in a safe savings account. Again, we know how money leaks out of our lives, where these policies become kind of a magnet for your money, right? Dumbasses like me, I need a little coaching and encouragement, right? I need something that attracts my money, because otherwise, I'll find something to spend it on.
We're pretty good at that, right? Yeah. And so here's how I think about this one too, Paul. When I was first meeting that orthodontist, I was 25. If you handed me a check for $10 million at age 24, do you know how much of that $10 million would still be in my control today?
Not much.
Oh, 0 is the answer. Now, when I met the orthodontist,
you must have some good stories, though.
I would have some amazing stories. That orthodontist, when I talked to him, and he was one of my first mentors around wealth building. When I met him and I learned some of this, now I knew the greatest place to store that wealth first. Yeah. So if you handed me $10 million at 25, I'm keeping probably 70% of that. I would have definitely lost 30% because I would have went out and speculated with it, yeah, and I would have lost a lot, but I would have kept some of it. Now, today, if you send me $10 million, I can promise you I won't lose one single penny of that. It'll go into my system first. It'll be captured, controlled permanently, and then I could deploy it for something else in the future.
Including fun stuff.
Including fun stuff. We're going to get to that in just a minute. So let's get orientated. Where do all these misconceptions of life insurance happen? Yeah. It's because we don't understand the path of money, right? We're working for money. Money flows into our life, and there's 4 things we can do. We can spend it. We can donate it. The rest is called savings. So the third thing you do is hold money with the option to invest it, which is the last thing, the most fun thing, I would say. We all want to go out and accelerate, right?
And modern day finance has forgotten the hold portion, right? Savings has really become passé. When you ask anyone, do they save? They immediately think my investments, right? My qualified accounts, and they should be 2 separate things in your life because they have 2 different functions in your life.
That's a great point. Do you invest? Yes. In what? I got a 401k. Awesome. Where do you save money? Oh, well, my 401k. See, savings and investing cannot be the same location. They serve very opposite functions of the money game. This is like having the gas pedal in your car and the brake. They're right next to each other. They almost look identical, but they serve the exact opposite function. So you need both, because acceleration sounds fun.
Yeah.
Until there's a cliff, yeah, and you can't brake, yeah, and your acceleration strategy just bankrupted you, right? Yeah. We call those events. And so life insurance exists in that green box. It is the most efficient. It is the toughest foundational asset you can own. Now, you can use that as part of your investment philosophy, but life insurance is not an investment. We have to keep repeating this because it is the biggest misconception people have around how to look at life insurance and where does it exist, right? The real estate, the stock market, the 401ks, the IRAs, all of those are investments. There's risk associated. There is no risk with your life insurance contract, or I should say the only risk is you and your behaviors.
Yeah.
If you don't fund it properly, if you don't obey the rules, you're kind of the only one that could ruin your whole life insurance policy. We'll put it that way.
Otherwise, every year, guaranteed to go up. Only question is by how much.
Exactly.
No volatility.
So let's review this again quickly. Everyone on the call is currently doing this, option number one. And here's how we think about this, Paul. I am going to save up money at whatever bank, and we're going to get $50,000 of liquid, safe cash at the bank. And then we're going to deploy that $50,000. We're going to reduce it down to zero, transfer it from the hold box to the investing box to go hopefully buy cash flow producing assets. We're big advocates for real estate. I think real estate is one of the most powerful investments that middle Americans can be owning, right? And the whole goal of investing is to make more money and have that return back to our hold category, right?
Yep.
And when that happens, we're going to refill the account again at the bank, and we call this the opportunity cost. We're going to drain that back down to zero each and every time.
Yeah, so as soon as you wrote that check to buy that piece of real estate, you're no longer earning interest, right? And that time between no interest earning the day you write that check and when you actually replenish the account where it's earning interest again, that's opportunity cost.
That's opportunity cost.
That's just not talked about very often. Very little out there.
In the financial world, we're so obsessed with how efficient can we make our investments, but we rarely talk about how efficient is your savings environment.
Storage, yeah.
When you got both of those working that hard for you, you are indestructible. You are unstoppable in the wealth game. But most people don't have a thoughtful framework on how to be efficient with their cash position. So what do? We add one step to this. You're going to use your whole life insurance policy and your bank account. So you're going to take those savings, you're going to direct them back to an insurance policy where you permanently control that money. And you're going to use that life insurance company to fund anything that you are going to do anyways. And these 8 benefits that we repeatedly talk about with life insurance, there's a difference between cost and value. And the value you get by saving money in life insurance, I don't think you can beat it.
Yeah.
It's got too many benefits in one place. Let's actually review those benefits, Paul.
Yeah, look, for me, the privacy portion is huge, right? As a physician, I'm always at chance for getting a lawsuit. These contracts are private, right? And we'll talk about them tonight publicly, but if you went to go look and find these policies anywhere, you're not going to find them. The second really big issue with me is some of the riders on there, the long-term care rider, the disability benefits rider. Those are really important to us. And then obviously we've talked about competitive yield. We've talked about the use of the loan provision. And I think you mentioned this, but when you took that loan out, what did the insurance company ask you once a year?
They would send me a statement for how much the interest that was owed.
And do you want to do anything?
Which, let's see, 17 grand, 5%
would have been probably
about $800
bucks. Yeah.
It was like, well,
yeah,
that's awesome because this home is appreciating like crazy.
You can pay it, or we'll just roll it into the loan for the next year. That's it. That is an unstructured loan with zero pressure as far as you pay it back on your terms.
Now, this is interesting because when I was buying policies as a 25-year-old, I loved the competitive yield and I loved that loan provision. Those were like, oh, this is great, like really neat stuff. As a father now of 4, and income has gone up, there's more risk there. The death benefit piece is so important to me now. It was way more important than it was just, nothing. Sorry, Diane, if you're on the call tonight, but having our kids now, I feel like I'm more obligated as a father to make sure that there's protection on my future income for my family now having kids in the play.
I just had a conversation with a friend of mine, and we were talking about potential insurance, and they had a decent amount of insurance, but I said, well, if you die tomorrow, who's your wife going to have to remarry? Because the amount of insurance you have just isn't quite enough to maintain your living status. She wasn't working at the time, and I think that sunk in, and you thought about it for a while. So it's one of those things where if you die tomorrow, do you have enough insurance that your family will not have to alter their lifestyle, right? And that's a real thing.
This is interesting because what is the percentage that we use life insurance during our lifetime? I mean,
Life.
it's 100%. Every single one of us will use this insurance at some point in our life.
We all die.
And I think that's an important question, Paul, because I might say, well, I'm insured for $2 million. That to me feels like enough. If I go ask Diane that, she might have a very different answer.
Yep.
No, I think that number should be 4. Whatever that is, we all have like what's called human life value. If you don't know what that is, please reach out to your Factum Wealth strategist. We'll help you with that calculation. You know, if you got a really fancy car worth $100,000 or whatever it is, are you going to insure that thing for $30,000?
No.
No, we're going to put full coverage on that thing. I mean, so if we're our number one asset, are we protected enough against an event that we have a 100% chance of using? And when I was 25, it didn't really occur to me. Privacy meant nothing to me as a 25-year-old. I had nothing to protect. We had no assets. A death benefit was not that important. Now, as a 37-year-old, 4 kids, I'll tell you the privacy of my whole life policies is more important to me than ever. The death benefit is more important than ever. But the greatest benefit we get is that everything on there is completely guaranteed in a contract. The amount of peace of mind, how I sleep at night knowing these assets perform and get better every single day. The death benefit's always there. We can always access that loan provision. It's always liquid. This is the toughest asset you will ever own at your foundation.
It becomes the crazy reason why you do not mind writing this check, because you know as soon as you write the check and it gets deposited into the insurance company that you have access to it, and then it's just bought your family additional insurance, right? Additional coverage. It's just bought you additional tax shelter as you get older. It's bought you additional money in your retirement income. There's so many great things about it. But that's all pinned by the death benefit, right? Because the larger the death benefit is, the larger all these other opportunities are.
Absolutely. And that affects the constant compounding nature of this asset, right?
Yeah.
So at the top, what are we constantly doing as Americans? We only use a bank account, so we're constantly in a state of interrupting any potential growth on our savings. You're either borrowing money and paying interest, or you're using cash, giving up interest you could have earned. And we learned that from becoming your own banker. That's the problem that Nelson Nash states in that book. So what are we going to do? We're going to add a whole life insurance policy to that list as well. And, you know, when we're just starting off, Paul, you're going to be a little bit behind the pure saver person using a checking account.
Right, because if you put in that, if you had 50,000 and you funded your whole life policy with 50,000, you might have anywhere between 30,000 on the low end to probably like 42,000 on the high end available to you, right? So people would say, well, that's almost like 18,000 at the most reduction. Like, why would I do that?
Yeah.
And this is where long range thinking goes on. But that $18,000 isn't, to me, it's not a cost. I was thinking about this the other day. That's buying me the death benefit immediately. It's buying me my future ability to control my taxes immediately. It's buying me privacy immediately. It's putting money outside the system, outside of any other contractual areas that can be, gotten at. So to me, it's not 18,000 that's readily available to you, but you got to believe that 18,000 is actually doing work. It's creating that foundation underneath you.
Everything you're buying all those additional benefits too,
yeah.
Right? There's death benefit protection. So you're not going to see this like really massive difference in the first few years of owning a policy. But you get these policies out 10 years, 15, 20, that's where you're going to see the separation. If you've been just using the cash method for 5, 10, 15, 20 years, this speaks to you. You're like, we're in the same spot we were 20 years ago with our cash. Every dollar you and I put into our policies, we still keep and control for life.
Yeah.
So Paul, let's shift gears now. We showed a great starter policy. Why don't you switch me spots and you can run through this, because this is your policy and I know that you're protective of the privacy.
Almost the same time frame, back in December of 2015, and we had just had a liquidity event with a business that I had owned, and we were building a forever house. One of my daughters has special needs, so we were retrofitting a house to live in, and if she ended up staying with us, it'd be a place to grow old in. And I was coming home from Bashes, and pulling out, and there was like bumper traffic, and there's that middle suicide lane that everybody knows about. And there's sort of two trucks, and the traffic was so much, and I was in a small sports car that I could not see the middle lane. But usually the middle lane is open. So I'm pulling out, and I'm about to go into the middle lane when the guy that was he was in like an F-150. He starts honking his horn, flashing his bright, and doing this to me. And I stop, and right there and then, a dump truck came barreling down the suicide lane. Ooh. I would have been dead, right? And I got home, and besides being a little shook up, I realized that Cindy and the girls would not have been a good shop. We had plenty of money in our 401k account, right? We had been physicians for, at that time, 15 years. But we were leveraged out on a new house build, right? And we had other things out there. And it struck me as, oh my gosh, you think you're doing right? And you don't realize sometimes the risks out there. That led me into the whole idea of looking at insurance, and then got into permanent insurance, was happy enough and lucky enough to meet Wade Borth up there. And Wade asked me the one need, and I said, I need protection, and I need a lot of protection. So Wade comfortably put me into a policy where every year I will write a $75,000 check and upwards of another $200,000 on years that we have that income and that liquidity to put into it, right? So this is a big policy, especially typically with infinite banking, whole life, you start small and go big. I did things backwards because typically, right, people get into these policies because they want to do infinite banking. Yep. I actually got into the policy because I wanted protection. I wanted my family to be okay if I were to get, shuffled off this mortal coil. So we bought a very big policy. There's term insurance on top of the policy, but the initial death benefit was right around $9 million. And this policy just says you're going to pay $75,000 every year, and then upwards of another $150,000 to $220,000. And again, heard the same thing. Low rate of return, right? Guess what? Right now, this policy is growing long-term net at about 3.5%. Okay, it'll probably get up to about 4% over the next several years. And every month right now, my cash value is going up almost $10,000 a year, or $10,000 a month. Every month, right?
So let's pause right there, Paul. So the policy I showed you was $220 a month is the minimum. The minimum on this thing is $75,000. I wish I had this policy that I could fund now, Paul.
Yeah.
We work with so many real estate professionals and business owners across the country. A lot of their investments, I will say, are not even beating the growth on your policy. And this is not an investment.
No.
To be netting almost $10K a month in cash value growth, and you got $1.6 million or so in this thing.
Yeah.
No risk, quiet as can be, no noise. That is the most efficient place you could store cash.
Money. And people can say, oh, well, you could have put money into the stock market. And I could have, except if I would have gotten hit by that truck a year later, that stock market's not going to be worth $10 million, right?
No.
Absolutely. So the day I wrote this first check, there was $10 million guaranteed coming to my family if something bad were to happen.
Now you do drive through the suicide lane. You have no fear now, right?
Yeah. Oh, I've got a big truck. So I actually did learn from that.
Okay.
So expensive to own, right? Thus far, as of this year, we paid just over $1.6 million in premium paid for just this policy, and we have $1.652 million of cash value. So we have over almost $50,000 more total than what we put in total.
So you're also over 100% of what you paid in. You have available, let's call it equity or the cash value. Yeah. And now you recouped 100% of your premiums, and you still have like over $7 million in death benefit on that thing.
And some of that other term insurance we actually converted that. I've got other whole life policies. So I still have that large death benefit. We've just converted those to whole life. And then the worst investment of all time.
Not an investment.
Not an investment.
This is a place where the McHale family holds and stores cash. Imagine using that thing that's growing $10,000 a month net to go fund your investments.
Yeah, yeah. And
hey, let me throw a thought to both of you, by the way, because I think that conversation about big or small, I think it's appropriate to say the following. This is a conversation that reflects two scenarios for two individuals in different times in their life, different stages of life, making life insurance a significant and relevant part of strategy. And that's a reflection of premium. That's a reflection of the level of education you guys had exposure to. that's also a reflection on how you related to the benefits. I don't know if anyone in the call, I know for us that are on the team, we're catching this, but if anyone is on the call and you're new to this, I hope you're picking up the theme. Kyle was talking about financing a home, the opportunity to grow, no kids at the time, right? Paul is talking about, hey, what if I die and my family is unprotected? All these benefits available at the same time for two individuals, sizing a premium relevant and significant to their life should be the lesson that every one of us sitting on the call take by asking ourselves, how would I make this relevant and significant through premium and through the benefits they're talking about?
And I think, David, just to add to that, real quick, the observation is what was important to Kyle, 25-year-old Kyle, is the same, but yet different than what it is today. And he got all those benefits immediately, even though he maybe wasn't ready to use it. But when he was ready to use it, then it was available to take advantage of. Again, when the kids come along, now his circle of his family and the abundance there becomes a little bit different. Now the death benefit becomes a lot more important. He doesn't have to go out and search for it and make sure that he's still insurable.
Right. You get it going early and you start maximizing those benefits. I want to maximize the benefits as long as I possibly can.
Yeah. And this kind of goes back to that initial diagram, that initial portion of period of time where you might not see 100% of what money you've put in be available to you. Understand that it's protecting you still. So you've guaranteed your protection for your family at that time. It's also building you that foundation that eventually is going to grow a very large building, right? All large houses, all large, compound, that you've got to have a foundation. And this is the best way to build that foundation. It's why we call it a foundational asset, right? It's why we just constantly talk about it within your wealth plan.
And so, Paul, a lot of people on the call are going to be in that first highlighted ramp up curve.
Yeah.
If you're 1 year in, 2 years in, 3 years in, that's what you're experiencing right now. Your policy that you've had over a decade, Paul, is growing $10,000 a month net. Yeah. You're in those more exciting years at this point. What's crazy is the first 10 years of the policy are the worst years. Years 11 through 20 go crazy, and years 21 through 30 get better. Yeah. The sooner you lock that in, the sooner you get to those constant compounding years that really take off.
And we kind of abused our policy. I've told this story before, but even in the first few years, we took some loans off, right? Because we were building this house and doing another investment that wasn't going well. And so we really used this policy quite a bit the first few years, not necessarily paying it back the way we should have, right? Got some religion, got some teaching on that, and started kind of changing our ways. But despite doing that, the policy still is performing.
Right.
Like it was actually, Wade sent me the original illustration earlier today, and it's kind of right tracking on.
It's a tough asset. It's going to do exactly what it was intended. And if you have good behavior around your money, you're using it and flowing free cash flow from your investments into it. If you're saving more money around it, you're going to accelerate the behavior.
Yeah. So here's just some quick numbers. This is an in-force illustration. So this is right now currently policy, year 11 on May 57. And total cash value at the end of this year will be right around $1.761 million, right? So for $150,000 in premiums this year, the policy is going to grow by about $204,000. So that's $1.36, right? So 36 cents up for every dollar. Year 24, age 70. I can't believe that's coming up that quick. Same $150,000 in premiums, but now the growth is going to go up by over $300,000, so 2-to-1 ratio. And Lord be willing to make it to age 80, which I absolutely plan on pulling on some tarpon at age 80. We're going to do that same $150,000, and the growth will be almost at $400,000. So you'll see I started this policy older than Kyle. My policy is structured a little bit different. So you might look at those numbers and not be as impressed. I actually look at these numbers and love these numbers, right? Because I can put not only 150, like I can make these numbers look worse by dumping $225,000 every year on these policies, which in some years we have done, right? So I hope to make those numbers mathematically look worse, but we know what they're doing behind the scenes. They're growing at an incredible rate. And I mean, you make it out to age 121 and these things go crazy.
They skyrocket.
Yeah.
And let's keep in mind, all that growth is net. net of any taxes on all of that. It's phenomenal.
All right. PowerPoint taking us a little time here today. Chewing on the numbers, I think.
And the thing that's always going to be a constant that's going to be going up here too, Paul, is, it's that family legacy that you started. We talk about this quite often as well, but now you've started this conversation, you have this in place, you get, your kids involved, sometime down the road, grandkids involved. This is the family legacy, and this is where it starts.
Yeah. So Jim Rome says, the average, the 5 people that you hang around the most is kind of the average that you'll get to, right? So this community, the reason I love this community so much is that you hang around people and you start to learn tax stuff and real estate stuff, right? Mm-hmm. And as a high income physician, tax and real estate stuff really helps us control our taxes insanely.
Right.
And obviously we have some liquidity. So never forget your why. My oldest daughter, special needs. This is up in Durango. That's Purgatory Ski Resort, which is right across from those windows there. And we decided in 2021 to build a home, and we were going to short-term rental it, which gives you some tax advantages. And we used our policy to help build this home. We're going to kind of go through some quick numbers as far as how that happened. There we go. There we go.
Thinking.
All right.
Yeah, use that one.
Use that one. All right. So what we did, this was a $2.6 million build, and we ended up using $1 million loan from the policy, along with a standard $1.6 million loan from a local bank up in Durango area.
Did we just lose Paul?
It looks like we lost your sound, by the way.
Kyle, can we hear you? Cannot hear you either, Kyle. One of the things while they're getting the battery figured out, and I've known this story too, the interesting part of that whole conversation was, but you have to remember, this was probably back in the day where we could get interest and access to loans at 3%. So here they are.
I think that one's dying. Are you
hear us
now?
Yep.
Okay.
So much like Kyle's, we just did the same thing, just a slightly bigger number. Instead of $17,000, $1 million, right? We used both tax savings as well as rental income to push some of that money back. So $225,000 was the first year and a half or so income from the short-term rental. And that just went back to both pay the interest to the insurance company, as well as help pay down the loan. And then we used additional cash flow, right? Additional liquidity events where we ended up paying down that entire $1 million loan. Now, I still hold the standard mortgage on this house that's down to about $1.2 million right now. But the great thing about this, and the fun part of this story, is similar to Kyle's, but the impact. So in 2021, interest rates were fantastic, right? They were sub 4%. Now, we had just started a new company, and I had become a 1099 employee. I told you I was dumb earlier, right? So I went and started going down the mortgage path. I'm getting a construction loan for this house. And I say, hey, bank, I'm going to, I'm going to need a loan for around $2.5 million. Can you do that? And they said, yeah, that's fine. You will need about a $500,000 down payment.
Nope, we lost you again.
No, sorry, guys, we cannot hear you. While you connect the mic there. Maybe we can take the conversation here.
How's that working?
Oh, there you go. There you go. We're
that
back.
Works? All right. So we're on this. So bank said $500,000 down payment needed. And we started doing all the tax returns, all that fun things. And about 6 months into it, after I've written a couple checks to start blasting and doing the foundation work, the Quicken Loans came and said, oh, we can't, you have to wait because you've only been 1099 employee for 9 months. We need you for over a year. So they said, you're going to need to wait 6 months for us to get a loan. All right, now this isn't for them. Where we at? Oh, there we go. So if we had taken that $500,000 and put it in a checking account at that time, hopefully it was earning 0.3% gross. The alternative is after I swore at the guy on Quicken Loans for a couple, I was on the roof hanging Christmas lights and yelling at the top of my lungs at this guy. Instead, I found a local bank in Durango, and I called the bank, and I remember someone saying, "Hey, banks actually own life insurance." So this bank, my first question was, "Do you control your own loans? Do you hold them?" "Yes, they do." I said, "If I show you a policy where I have just over like $1 million of cash value, would you use that as collateral to loan me an additional $1.6 million for a construction loan, even though I'm a 1099 employee for only 6 months?" And he said, "Yes, provided you send us the past 2 years of tax returns and a copy of the policy." And that was it. So 2 minutes later, email went out. And I kid you not, 6 days later, we had a mortgage.
There you go.
For 1.6. So that same $1 million that we took a lien against our policy of continued to stay in the policy, earning 3.5% net long term. And that interest, when I get to be age 82, will be worth $3.1 million. If we had gone the bank route where we had written that check for $500,000 and earned, say, 0.3%, that would have been a loss of about $1.4 million in interest. Now, you've got mortgage costs. Here's the other kick to this story. Timing is everything. In 2021, the interest rate we were able to get from, God bless you, Alpine Bank in Durango, was 3.75%. If I had waited for Quicken to come around to my 1099 employment status, the rates had already gone up to 5.2%. It would have been an incredibly more expensive loan. So that mortgage would have cost us $2.1 million in mortgage interest, a total right around of $2 million in interest payments total. On the flip side, we do have a $1.6 million mortgage at 3.75%, and then we had this loan at 4.75% from the insurance company. Same cost if we had paid off both of those over a 30-year time period, comparing apples to apples, the total cost for that interest would have been around $1.7 million. So you would have saved $300,000. However, remember, Kyle, we're earning money, right? Constant, that $1 million continues to earn money over $3 million, right? So in the end, there's a $2 million net increase to my family's wealth just by choosing to use whole life insurance. Same property, same investment, same use of short-term rental, tax loopholes, all those wonderful things, but a $2 million difference. That's incredible.
I love that story, Paul. And just the freedom and the flexibility to go make something happen.
Yeah.
Right.
And the joy that house has brought us, right? The ability to sort of synthesize all these things that we learn in this community as far as controlling taxes, controlling all those functions of life can make a huge difference.
Massive. And I think one of the takeaways that hopefully you're getting from tonight's call is the compounding does not care when you start, right? Compounding is compounding. Compounding only rewards those that don't stop. And if you're looking at this graph, the blue line and the green line, they equal people that are only using whole life insurance as a saver or a part of their wealth building strategy. When this stuff really starts to connect for you, and you move into what we call the stage 3, the business banker, when you start treating your system of life insurance like its own separate business and you're directing more free cash flows into that environment, you're going to see these exponential spikes in how much of your wealth you're actually controlling year over year. And this is why we're obsessed with the infinite banking concept.
Yeah.
Utilizing infinite banking does not slow you down in any other part of life. And if anything, it creates this tailwind that pushes you more aggressively towards the things you want to do, but it does take a little bit of time to get them running.
It puts you in front of opportunities that you would have never noticed before, right? It's the red truck effect. But people, if people know you have liquidity, they will approach you because they know you're like, hey, can I get $200,000 for this fantastic investment? I'll personally guarantee it. I'll pay you 12% plus 2 points. Personal guarantee backed up, right? Those are things that liquidity gives. And that's on top of the net 4%.
Right. That's the worst it's going to be when you use this as part of your wealth strategy, as part of your family banking business, whatever the path is that you're on. it only accelerates it and keeps it building.
Yeah.
So let's take a look at this now. Let's go back to these 8 benefits. You see, that loan provision at the right time allowed you to get a smoking deal and create those memories with your family.
Yep.
Just having the flexible loan provision save you a few $100,000 on just the normal loan interest.
Just loan interest.
Let alone you got the home faster with less headache.
Yep.
I mean, I'm picturing you screaming, putting the Christmas lights up. Like, is there anything more frustrating than having to prove to a financial institution that you can do this, right? Like, for business owners, for entrepreneurs, for investors, the bigger your cash values get, the less reliance you have on that typical financing system.
I think, one of our favorite restaurants before COVID hit was right across the street from us. And they went under because they lacked liquidity, right? They were trying to make ends meet. They're doing takeout, and they just didn't, if they would have held on another 3 months, it's when everything sort of opened up. And the 2 other restaurants survived in that complex. But you think about all those times where a little bit of liquidity can buy you that extra time or get you to that extra opportunity. My hunch is there's people on this call tonight that absolutely have been in that same situation.
Well, and how easy is it to hold liquidity when your policies are growing? That first policy I have grows $500 a month net. Yours is growing just a tad bit larger, $10,000 a month net, right? It's easy to hold liquidity when your cash position is that efficient. So let's wrap this up. By placing whole life insurance in the right place in your wealth path, you're going to feel financial pressure when it comes to just an unpredictable income. Those of you that are investors, business owners, maybe not the stable W-2 paycheck, you experience unpredictable income. It builds financial pressure. Now, when your policies are producing for you every single month, that helps alleviate that unpredictable income pressure.
Yeah, because you can always just pull a loan for them temporarily, right? And then when that income comes in, you just fill the bucket back up.
Especially as they get more seasoned. Now, excessive spending. When you have an environment that's growing $10,000 a month, does that make it a little bit easier to spend less and save more when you know your dollars are working for you that hard?
Yeah, it goes back to that what I said earlier. Like this is a magnet for our money. Where one never existed before, right? You put money into a 401k and you kind of look at it every month or maybe a little bit sooner, but it's not that draw to me. Whereas this, I know where this number will be. You can almost look at your illustration and kind of say, well, I know where it's going to be next year.
Yeah.
That gives you a lot of comfort.
A lot of peace of mind.
Yeah.
What about reliance on credit? Now, I mean, the policy you showed, you've got substantially more cash value now.
Yeah.
The bigger your cash values get in your banking system, Paul, the less reliance on credit you now need.
And the great thing is the easier it is to get credit. So we're doing a deal up in Idaho, and all I needed to do was send 1 year tax return and a copy of the policy.
Right.
And we've got a loan for the RV park, right? It becomes banks will loan to you because they know you're good with money and they know that that's in the background.
Safe, secure asset. Another big one is lack of liquidity. We don't carry enough liquidity. Part of it is because the environment that we're saving cash in is so inefficient. A typical checking or savings account does not give you enough benefit for you to hold a large portion of liquidity. But when your policy is working 24/7, it's private, there's protection in place, it's a lot easier to hold liquidity. And think about your policies, Paul. If you're netting 10 grand a month in growth on your policy, does that change what investments you're willing to look at?
Yeah. I don't have the urge to be in everything all the time, right? It's blood on the streets, right? You really start to be much more careful with opportunities because, at some point opportunities will come along.
Absolutely. The ability to be patient is one of your greatest advantages in the money game. And last thing, retirement uncertainty.
Yes.
Now, those policies that we just showed you, both of us can convert those into passive income streams to support whatever retirement plan you want to fund.
Yeah.
I think that's the other beautiful part. Every dollar I'm saving to that, I'm using for opportunity while I'm live. I'm banking with it. I'm controlling more of that flow of money. And when we get to that age, whenever we wanted to retire, Diane and I can convert those policies into a retirement type of income stream.
It can help with cash flow retirement, volatility buffer. It can annuitize. It lets you spend. I think Curtis Cloak says it. It releases the hostages. Your 401k account that you're afraid of spending because you don't know how long you're going to live. Suddenly, those hostages are released. You can spend that money freely.
So think about those 5 things: unpredictable income, excessive spending, reliance on credit, lack of liquidity, retirement uncertainty. The more aggressively you're funding your life insurance premiums, the less financial pressure you feel in all 5 of those areas. Just a brilliant, brilliant asset.
Yeah.
Now, let's wrap it up with this. Next month, we're going to be talking about multi-generational wealth transfer by utilizing the family banking business. So we talked about a couple single properties, one that I bought, one that Paul's family bought.
Yeah.
Now, if we incorporate this now, Paul, on a family level, think about all the vehicles your family is going to finance, all the homes that'll be purchased. This is not an investing conversation, it's a control conversation. So our deep dive class for March is on the family banking business, one of my all-time favorites to teach on. So we'll leave these QR codes up for a minute. If you want to scan those, you can get access to both those videos if you want to get a head start on the ideas. Now, we're going to be going deep into the family banking business, more so what are the conversations you should be having with your family? What do those meetings look like? And so with that, I know we're a tad bit over time. If you got to hop off, we want to be conscious of your time, but I'd love to take a few questions from anyone. If we have those in the chat, David or Wade, love to answer any questions.
Yeah, just to clarify for everyone on the call, everyone that register will receive a link to the recording of this call if you want to review maybe the numbers or some of the examples at your own pace, just so you know you all are going to receive. Daniel Carter asked a question earlier, Kyle. Does your dividend or cash value growth each month change by the policy loans?
Great question. So the answer to that is no. Your policy is going to perform at least with One America, whether there's a loan against it or not, right? So if we have a $50,000 loan, I've got $100,000 of cash value, I'm still getting the same dividend and all that growth, regardless of whether there's a loan against the policy or not.
Yeah.
It's not necessarily the same for every insurance company, but it is for One America. It's what's called a non-direct recognition company. So sleep well at night, Daniel, that when you have loans against your policy, you're getting the maximum benefits from growth and dividends. Great question.
Absolutely. I think that's the only question in the chat currently. Any other questions from anyone? Brian, hi.
Yeah. Who owns the policy?
So the individual will own the policy. So the one that I showed, I'm the owner, I'm the payor. Our trust is the beneficiary along with my wife.
Okay.
And so we have policies on our kids. And so I'm the owner, my wife and I are the owners, and we're the payors, but it is on the life of our children. So if they pass away, our trust is also the beneficiary. And so you can own and fund insurance, and it does not have to be on your own life. Now, they're real flexible with how you can set some of these things up.
As long as you have an insurable interest in someone.
So is it irrevocable or revocable trust?
We have a revocable living trust.
Okay.
Now, there are some strategies, and that would be a great question for some estate planners we work with if you're thinking about going irrevocable status on your trust.
Okay. All right.
That's a fun deep dive.
Yeah.
Thank you for your question, Brian. Go ahead,
Yeah.
Wade.
Yeah, and I would probably just encourage anybody that's on the call, and just imagining how you could use this in your life, right? Just imagine how, again, Paul's policy is unique to him, Kyle's unique to him, to Kyle, David's unique to himself, mine's the same way. So, but the point is, just imagine this type of scenario. I can share 2 or 3 stories exactly what Paul was saying, maybe not to that scale, but something very similar, where access to cash and access to money breeds great opportunities. Great discount to buy a piece of property, close in a couple of days, just all these other things that happen because you have access to cash and you control that function in your life. You're not dependent on somebody else to give you a thumbs up and thumbs down. So I'd say if you can imagine this in your life, whoever invited you to this content, invited you to listen, go back with them and say, how could this work in my life at a scale that is impactful to my financial situation?
Absolutely. You know, the number one point of feedback we get on these is, I wish I would have known this stuff 20 years ago. And the compounding doesn't care when you start it. It only rewards those who never stop.
Yeah.
The reality is we all have another 5, 10, or 15 years for sure.
Yeah.
You might as well maximize as much of those years as you possibly can. And so think about what decisions are happening in your life and how much of that flow are you controlling. This is not an investing conversation. It doesn't change anything in that gold box, that investing category. It changes the underlying structure of where your cash position is. If that is working as hard as it is with these two examples, your financial situation is so much better and so much tougher. It'll change the way that you look at investments ever again.
Yeah. We have one more question for David, and I apologize if I mispronounced your last name, Benoit, I believe. David, thank you for your question. It says, what happens when the worst happens and you can pay the loan for several years?
Yeah.
It's a great question. So this is a little bit nuanced, but if you've been on our Tough Money curriculum, setting the proper liquidity reserves is going to be vital to that. The only way you can get out ahead of your skis on this, if you will, is if you're max loading policies and then you put yourself in a position where you have loss of income. And now not only can you not pay back your premium or pay the premiums, but you can't pay the loan interest either. So you want to be a little bit careful. I am not a big proponent of maxed out policies. I always want to leave some type of buffer. If you've got like 5 or 10 policies, like a lot of us do, don't loan everything against it. Leave some type of cash buffer there for those events that sometimes we just can or cannot see. Now, there's a lot of flexibility in these plans. So just know you probably have 5 or 6 different options that your insurance agent, your fact and wealth strategist can run you through if you're experiencing some financial pressure in your life. There's a lot of different options you can utilize.
Yeah, and part of being an unstructured loan is it comes with that responsibility to manage that, but at the very least say, well, what if I could just pay the interest? And then that could be the interest only until you get in the position where. So there are options.
Absolutely.
Yeah.
Great questions.
Thank you, David, for your question. Any other last minute questions before we close the call, gentlemen and ladies?
Well, we appreciate everyone hopping on and spending a little over an hour tonight with us. Hopefully you learned something new. The next thing is go implement this now. What are you not seeing in your financial world? Where can you improve the efficiency of your cash position? Solve that problem, and a lot of things start falling in place for you financially. So we appreciate you hopping on with us. We'll see everyone in March for our next deep dive, which is all in the family banking business and the multi-generational wealth transfer. So thank you again for showing up tonight. We'll see everyone next month.